Ramesh Kalyanaraman, Executive Director at Kalyan Jewellers, now joins in to talk to us about the quarter that's behind us and what lies ahead. Hi Ramesh, good morning. Thanks for joining in. It seems like the markets and brokerages have given the earnings for Kalyan Jewellers a thumbs up, largely better than what the street was expecting. Profitability has been impacted due to higher employee costs, which I believe was planned on back of store expansion, and also higher ad spends. You want to walk us through how the quarter has been and what we should be expecting in terms of volumes and profitability for the rest of FY25?
Yeah, so thank you. Yes, the quarter was good. Q1, the revenue momentum has been very strong. India grew by around 29%. SSGs have been very strong in the range of 12%. It comes with a very high base as well, because last Q1, the last financial year, the SSGs were 15%. This 12 comes over and above that. And as we speak, July is also trending well, especially after the duty cut. The momentum is further accelerated at the stores. And yes, in Q1, advertisement spends were higher than estimated. It was predominantly in areas where we saw competition from local organized players in a particular region or a store. So the gold prices were also very volatile. So we did not want to go weak on our marketing, and hence the marketing budgets were a bit overshot when compared to estimates. But we spent more on advertisements in the newer markets to accelerate market share gains. Aggressive network addition is also a reason.
Ramesh, hi, good morning. Tamanna here, and stellar set of numbers on the revenue front. Obviously, your EBITDA margins hit this quarter because of expansion plans, so that's obviously seen as a positive. But I'm just wondering when you see a recovery on EBITDA margins and to what extent?
No, so EBITDA margins hit is not predominantly because of that. That is because of our franchisee expansion, wherein franchisee stores come with a lesser EBITDA margin when compared to owned stores. That is the major reason for EBITDA margins to degrow, and it will keep degrowing because our expansion for the next couple of years is predominantly with franchisee capital, and the EBITDA will keep degrowing. Focus should be on PBT margins. In Q1, our estimates was to have PBT higher than our revenue, which is now at same levels because of the marketing spend.
Okay, so just to follow up on that, so you said EBITDA margins are getting squeezed because of franchisee expansion. They come in at a lower profitability. It will continue. Till what extent do you expect a further hit? Give us a range.
So profitability actually in PBT terms, franchisee stores.
We'll come to PBT terms. Ramesh, can you just tell me about EBITDA margins and then we'll come to PBT, please?
Yeah, so EBITDA will be, because our own store EBITDA is in the range of 8%. Franchisee comes with a 5% EBITDA. Okay. And all our expansion is in franchisee, and EBITDA will keep degrowing. So we should estimate EBITDA degrowth for the next 2.5 years.
What extent, sir?
So it will further come down, maybe by say 0.5% to 0.75% over the next 1.5 years.
Okay, so you're seeing it going down to about 6.2%.
But again, I know that you are going to come back to PBT, but PBT will keep growing.
But just before we come to PBT, Ramesh, good morning. There is a belief in a couple of notes that there is a new franchisee agreement that you're going to come out with, which will actually shore up the margins. So can you explain this dichotomy between what you just told, Tamanna, versus what brokerages are estimating?
Yeah, so PBT margins or EBITDA margins are at 5% for our existing franchisee stores. The new stores which we have signed up comes with a 5.25% EBITDA margin. So 0.25 more than before. That's the new model.
Okay. But all things considered same, you're still going to see a hit on EBITDA margins. Let's come to profit before tax now. Since you've been highlighting that is a more important metric to look at, let's start with why you think it's a more important metric to look at and then where you see that going.
So why? Because our EBITDA margins, because EBITDA, when you go to a FOCO model of franchising, wherein you give a good revenue or a margin share to the franchisee partner, your EBITDA will come down. But on a PBT level, when our own stores are at 4.7, 4.8, the franchisee stores come at 5%. So that is why the PBT margins should keep growing, meaning the PBT should grow more than our revenue. That's our target. But in Q1, it has not happened because of higher marketing spends, because the gold prices were very volatile, and we did not want to lose market share in especially new markets where competition was also very active on advertisements.
Okay. Okay. Ramesh, I'm sorry, I still don't get the disconnect out there, because if your EBITDA goes down, your PBT naturally will go down per se. There's no way that the PBT will do better than the EBITDA growth, right? Unless you are paying off something on interest or depreciation. So I think those rates will commensurately similar, right?
Yeah. So no further depreciation, because all
Got it.
Yeah. Yes.
Okay. Now, just the growth per se. I mean, the belief was that this whole price downtick in gold prices will lead to an uptick in sales. You have done very well on sales. My question is, what's the run rate that you anticipate for the rest of the year? And has that estimate changed post-budget because of the duty cut?
No, so now when we speak in July, of course, the SSGs are actually better than Q1. And that can be a short term because price came down suddenly quickly because of the duty impact, and customers started rushing to the stores, especially over the last 10 days and in weekends. And that can be a temporary phenomenon. But midterm, long term, this duty cut is really going to impact or get an advantage for organized players, because the pricing difference between before and now, especially because of duty, the unorganized players, the initiative for a customer to go to an unorganized player further came down because the margins are lesser due to the duty cut.
Okay. So, Ramesh, then if you are seeing a decent July and presumably that continues into August, and then we hit the festive season, September, October, are you set for a strong second half of the current calendar? Would Q2 and Q3, which is the current quarter, the next quarter, be stronger than what is anticipated otherwise?
As we speak, yes, we are very upbeat about Q2 and the festival.
Ramesh, just trying to understand, you talked about how the import duty cut helps you because those going to unorganized players might rather come to you. I'm just trying to understand, what was the inventory hit for you? I mean, all players would have had an inventory build up at higher rates. What was that for you?
Yeah, so this will lead to a one-time loss of approximately 120 crore, which will come partially in Q2 and Q3, but yes, it's a one-time.
Okay, so one-time loss of 120 crores that we could see over the next 2 quarters. All right, well, before we round up this conversation, Ramesh, tell us about what you have on the anvil strategically, what is in plan for the rest of the financial year?
So expansion is on track. We already opened 5 Kalyan showrooms and 2 Candere showrooms in the month of July as we speak. And we will open 35 more Kalyan and 20 more Candere before the festive. And Candere has completed documentation for acquiring the remaining, and it will be a fully owned Kalyan company in a couple of months. And that's the plan.
Anything which you're doing on lab-grown diamonds, that's the hot conversation in your sector right now?
So lab grown, as we speak, we don't see any demand at our store level. And as a retailer, we will supply if there is demand, right? So as we speak, we don't see any demand, and we are closely watching. And lab grown diamonds, the prices have not been stabilized. So as a retailer, as a brand, we also cannot push because we ourselves don't know where the price is going to settle down. So that is the update about lab grown diamonds.
Interesting. Thank you so much, Ramesh. Kalyanaraman, Executive Director at Kalyan Jewellers, talking about the quarter gone by.